Welcome back to the deep dive. Today we're tackling one of those behemoths of global commerce. The companies that really underpin our everyday lives, but they often operate almost silently in the background.
Exactly. We're talking about firms that control these vast economic landscapes, but most people, if they've heard the name at all, only vaguely recognize it.
And when you think about the global economy, your mind probably jumps to the big consumer brands, right? The products you buy, the websites you use.
But behind every single one of those brands, there's a physical footprint. There's the headquarters, the massive warehouses, the data centers. And that commercial world, that's a universe all its own, and it is ruled by scale.
And today we are diving deep into, well, the undisputed king of that universe,
Yeah.
CBRE Group. Our sources have given us this incredibly comprehensive view of the company. It's, what, 119-year history?
119 years of transformation, and it's just immense global footprint.
So the mission for this deep dive is pretty clear. We're going to take you from just, recognizing the initials CBRE to really understanding it.
We want you to see not just that it's the world's largest commercial real estate services and investment firm, but how it got that big.
And crucially, what it actually does for, well, the majority of the world's biggest companies and investors.
We have to start with the scale because it's just staggering.
It really is. Based on its 2022 revenue, CBRE Group is the world's largest firm in its class. They're a component of the S&P 500, which is a huge indicator of market stability.
And this is the number that always gets me. They serve over 95 of the companies on the Fortune 100 list.
95. That's basically everyone. It's total market saturation at the very top.
And when a company is that embedded, managing the physical world for the global economic elite, they're not just a service provider anymore. They're a piece of the global infrastructure itself.
Right. So understanding CBRE is really understanding how global commerce keeps its physical spaces running and growing and changing.
You got it.
Okay, let's unpack this. Let's start at the beginning. Who they are and, where this whole monumental operation is actually run from.
Well, the name itself, CBRE, it's a great place to start. It's basically a historical snapshot of their whole century of mergers and acquisitions.
Right. That's our first point here, core identity. If you've ever wondered what those letters stand for, is Coldwell Banker Richard Ellis.
It's not just a corporate name. It's like a family tree of all the major firms they've swallowed up over the decades.
And that history is absolutely essential to understanding their DNA.
And their physical locations today, their headquarters, they really reflect the complexity of the business, how they're constantly balancing operations with, high-level financial strategy.
So they have this dual headquarters structure, which is a statement in itself.
It is. Their main corporate headquarters is in Dallas, Texas. That was a strategic move they made in 2020, shifting from Los Angeles.
And that Dallas move, it just makes sense on a practical level, doesn't it? It's a great logistics hub, business-friendly environment, deep talent pool. It's just a smart place to manage a huge global workforce from.
But the source material points out this crucial counterbalance, their global financial headquarters.
Which is much newer, established in January 2025 at the iconic Lever House in Midtown Manhattan.
And that dual structure is just the perfect picture of what they do. You keep the day-to-day corporate machinery, the HR, the IT, the operational core in a super efficient hub like Dallas.
But then you plant your financial flag right in the heart of global finance.
Right in Midtown Manhattan. It's a signal to investors, to sovereign wealth funds, to private equity, that their focus on capital, on investment, on the big strategic plays is still centered right where the money is.
You have to be where the big decisions are made, and that's New York.
Unquestionably.
So let's talk about their market position. In the commercial real estate world, everyone talks about the big four, and CBRE is, well, at the very top of that list.
That is the essential context. The big four, that's CBRE, Cushman & Wakefield, Colliers, and JLL, they control the vast majority of this entire global industry.
It's not a fragmented market at all.
Not in the slightest. It is highly consolidated. And based on that 2022 revenue, CBRE leads the pack.
So just quickly, what's the real difference between these four? I mean, are they basically interchangeable?
No, not really. They all offer a broad suite of services, of course, but they come from different places. JLL, for instance, is known for being very strong on the corporate solutions and consulting side.
Okay.
Cushman & Wakefield often has these really deep regional specialties, but CBRE's dominance, it comes from something else. It's just sheer, unparalleled scale across every single service line.
And they got that through acquisitions.
Through a decades-long aggressive acquisition strategy that just systematically bought up any service or expertise they didn't already have. They want to be the biggest and the best at everything, everywhere.
And you see that reflected in their Fortune status. They're ranked 135th on the Fortune 500 list. And what's really impressive, they've been on that list every single year since 2008.
And think about what that means, that continuity. It signals incredible resilience. They navigated the Great Recession, the huge shift to e-commerce, the chaos in the office market post-pandemic,
And they just kept growing.
all while staying in the top 200 of American companies. It proves they can adapt their model to, these profound economic shifts.
So we have to circle back to that client list, serving more than 95 of the Fortune 100. My question is, if you're serving literally every major company, aren't you constantly facing massive conflicts of interest?
That's an excellent question.
I mean, what happens when you're negotiating a lease between two of your biggest clients who are on opposite sides of the table? How does that work?
It's managed through really rigorous internal segmentation, what they call the Chinese wall. So if they're representing, say, Google in leasing a space from Brookfield, and both are huge clients, the deal teams are completely siloed from each other. But the real answer is that for the clients, the advantage of CBRE's scale and their data often just outweighs that conflict risk. If you're a global company, you want one firm that can give you the same service in 60 countries and has better data than anyone else.
So the scale itself becomes the benefit that overrides the potential conflict.
Exactly. The efficiency is worth it.
And as we said, they're on the NYSE, ticker CBRE, and they're a key S&P 500 component, which means the investment world basically sees CBRE's health as a barometer for the entire global property market.
Which brings us to the numbers. Let's quantify this scale with the 2024 financial data we have, because this is what really grounds the whole discussion.
And this is where the numbers just get astronomical. According to the 2024 data, CBRE's annual revenue was $35.8 billion.
Let's put that in perspective. $35.8 billion. That is roughly the same as the annual economic output, the GDP, of a country like, say, Latvia.
Wow.
We are talking about an economic engine on a national scale, just driven by service fees and contracts.
And if we drill down into the profitability, their operating income was $1.41 billion, which led to a net income of $968 million for the year.
And in a cyclical industry like real estate, those are incredibly strong, sustained profits.
Right, and then there's the balance sheet. Total assets of $24.4 billion, supported by $8.41 billion in total equity.
And for a services firm, that equity number is so crucial. It represents their ability to back their own investments, to handle debt, and most importantly, to be the anchor when they go out and make these multi-billion-dollar acquisitions that are so central to their growth.
And to manage all of this, they need an army. 140,000 employees worldwide in over 500 locations. A truly massive global network.
So if we connect this to the bigger picture, these numbers really point to two core truths about the market right now.
Okay.
First is concentration. The fact that one firm can generate nearly $36 billion in revenue just shows how centralized this industry has become. Clients want, one throat to choke, one global partner.
And the second truth
is the reliance on sophisticated, localized knowledge. That's what the 140,000 employees gives them. They have local experts who understand zoning laws in Shanghai, leasing rates in London, and development risks in Dallas.
So it's that granular, on-the-ground intelligence, but coordinated centrally.
That is their defining advantage. It's a level of insight that smaller competitors just can't possibly match.
That scale is impressive, but let's get into the weeds. What are they actually selling to make that $35.8 billion?
It really breaks down into two distinct audiences, two client types with fundamentally different needs. They serve occupiers and they serve investors.
Okay, so let's start with the first group. Services for occupiers.
The occupier is the company, the organization, the government agency that actually uses the physical space to run its business.
So a tech company's headquarters, a bank's branches, a retailer's stores.
Exactly. They need the space, whether they lease it or own it, but their main goal isn't real estate. It's running their own business. Real estate is a cost center for them, not a profit center.
So CBRE basically comes in and acts as the outsourced real estate department for these huge organizations. What are the key services they're providing?
Well, the first big one is facilities management. This is the operational core. It's the, keeping the lights on so the staff can work part of the business.
Day-to-day operations.
The whole thing. Maintenance, HVAC, managing the cleaning crews, security, making sure the cafeteria runs smoothly. For a multinational company with thousands of locations, outsourcing this is just a massive efficiency gain.
And then you have project management. That seems more future-focused.
It is. This is beyond just maintenance. Let's say an e-commerce giant needs to build a new million-square-foot logistics hub from scratch.
Or a big corporation wants to completely gut and renovate its headquarters for hybrid work.
CBRE manages that entire project. The timelines, the contractors, the budgets, everything.
And of course, there's transaction services. This is the classic brokerage part of the business, right?
For the occupier, yes. This is property sales and leasing. They're the ones finding the right office space for the client, negotiating the complicated lease terms, handling renewals, and just managing their whole global portfolio of properties.
They also provide layers of more strategic support, things like consulting services on how to optimize space.
Right. Is it better to buy or lease in this market? Should we consolidate 3 offices into one giant campus?
And they also offer financial services for property financing and valuation services to help the occupier understand what their real estate is actually worth.
It's a complete end-to-end spectrum of operational support. The goal is to let the world's biggest companies just forget about the physical headaches of their real estate and focus on their core business.
Okay, so that's the occupiers. Now let's pivot to that second crucial audience, services for investors.
Right. If the occupier uses the space, the investor owns the space. For them, real estate is purely an asset class, like stocks or bonds.
And who are these investors typically?
We're talking about massive pools of capital, pension funds, insurance companies, sovereign wealth funds, private equity firms. Their only goal is maximizing the return on investment from their buildings.
So CBRE services for them must be totally different.
Completely different, focused entirely on capital optimization and risk management. The core function here is capital markets.
This is the high finance side of things.
Entirely. This isn't about finding a 10,000 square foot office lease. This is about massive property sales between institutions, a $500 million office tower changing hands. It's commercial mortgage brokerage, loan origination, servicing. They are the facilitators of global capital flowing into real estate.
And they also do property leasing and property management for investors, but I'm guessing it's with a different goal in mind.
A fundamentally different mandate. For the investor, property management is all about maximizing rental income, aggressively keeping vacancies low, negotiating hard on leases, and maintaining the building's value. The goal is profit maximization, not just making sure the lights stay on.
And another huge one is investment management.
This is a massive, highly profitable business for them. CBRE manages entire real estate portfolios on behalf of these big institutions. They advise them on where to put their money, industrial, office, logistics, multifamily, and then they execute the buy and sell decisions.
There's also development services.
Which is essential for investors who want those high ground-up construction returns. This is where CBRE helps a developer take a raw piece of land, get it zoned, manage the financing, and actually build the building. It's high risk, high reward, and requires deep, deep expertise.
And the source has made a point to highlight sustainability services specifically for investors. Why is that so important right now?
Because it reflects this profound market shift. ESG, environmental, social, and governance, is no longer a nice-to-have. For large institutional investors, it's a fiduciary duty.
They have to prove their assets aren't going to be worthless in a future of climate risk.
Exactly. They can't own stranded assets. So CBRE comes in and helps them assess, report on, and actively improve the energy efficiency and carbon footprint of their buildings. It's a financial risk mitigation service, really. A green building gets higher rent and holds its value better. CBRE is selling future-proofing.
Which brings us to the perfect overlap point. Some services, like valuation, are critical for both groups. An occupier needs it for a lease, but an investor needs it for a multi-billion-dollar acquisition.
Absolutely. And the fact that they provide this exhaustive start-to-finish suite of services, it creates this incredible client stickiness.
They're embedded across the entire life cycle of the building.
From deciding where to build it, to financing it, to managing the cleaning staff, to selling it 10 years later, that creates these highly predictable, recurring revenue streams. It diversifies their risk. And most importantly, it gives them unparalleled market data.
They know exactly what the biggest companies in the world are buying, what they're selling, and what they're going to need next.
Precisely. It's a self-reinforcing loop of scale and expertise. The more data they have, the better their advice is for the next client, which just widens the gap between them and their competitors.
I have to ask, though, how can one firm really be excellent at all of those things? I mean, you're managing cleaning crews for Apple on one hand, and on the other, you're advising BlackRock on a portfolio sale. Those are completely different skill sets.
That is the entire point of their 100-year history of acquisitions.
Mhm.
They didn't start out that way. They bought that expertise.
So they didn't grow it organically.
Not at all. They didn't organically build the world's best facilities management system. They went out and bought Norland and Global Workplace Solutions. They
Mhm.
didn't organically build the world's best project management team. They bought Turner and Townsend. Their strategy is to identify the absolute best-in-class player in a high-margin field, absorb them, and then plug them into the CBRE global network to instantly scale their reach.
So the answer to how do they do it all is simple. They buy it.
They buy it.
And to really understand that, we have to track the history. This isn't a story of nice linear growth. It's a story of strategic turbulence, mergers, and financial agility that spans almost 120 years.
Right. Section 3 really tracks this tumultuous path. We can start with the early days, the Coldwell era, from 1906 to 1981.
The firm was founded on August 27, 1906. The original name was Tucker, Lynch, and Coldwell. And you have to remember the context. This is San Francisco, just months after the devastating 1906 earthquake.
The environment was just one of, intense destruction, but also explosive rebuilding. The city had to literally reinvent itself. The need for professional, organized real estate services was immediate, and it was immense.
A key change happens in 1913. A man named Benjamin Arthur Banker joins as a partner.
And that solidifies the CB in what would eventually become the brand name. The next few decades saw a few more name changes. Coldwell, Kernan Banker, Coldwell, Cornwall, and Banker.
Those little changes really reflect the shifting partnerships as the firm was, finding its identity.
And by 1974, after expanding successfully across the West Coast, they finally shortened the name to just Coldwell Banker, a very recognized brand in both residential and commercial real estate at the time.
But then the story takes this really jarring detour, the Sears interlude. In 1981, Coldwell Banker was acquired by Sears, Roebuck and Company.
This is part of that often misguided corporate trend of the 1980s. Sears was trying to build a financial department store.
Right, the idea that you could go to Sears to buy your insurance from Allstate, manage your investments with Dean Witter, and buy or sell your house through Coldwell Banker, all under one roof.
It might have looked good on a corporate strategy deck, but commercial real estate was just a fundamental mismatch with the retail giant's core business.
I can't imagine the culture clash, trying to integrate institutional brokerage with selling washing machines.
It was completely unsustainable. And by 1989, Sears realized this and sold off the commercial unit. This was the critical transaction. They sold it to a management-led buyout group for about $300 million.
And that buyout group famously included the private equity powerhouse, the Carlyle Group.
And that $300 million sale was the pivotal moment. It was a real birth of the modern CBRE. The commercial unit was spun off and renamed CB Commercial Real Estate Group, now totally focused on offices, industrial, and retail.
While the residential side kept the Coldwell Banker name and went on its own path.
And the inclusion of Carlyle was key. It injected this private equity mindset into the company's DNA, a culture of aggressive growth, cost management, and market optimization. That sale is what defined the company we see today.
And that newfound independence just fueled the next phase. The birth of the CBRE name and this wild IPO cycle between 1996 and 2004.
Exactly. The new CB commercial knew that to fund the kind of global expansion they wanted, they needed capital. So in 1996, they went public with their first IPO, raising a modest but important $80 million.
And they put that money to work immediately.
Instantly. In 1998, CB Commercial merged with Richard Ellis International. And that's when they officially changed the name to CB Richard Ellis CBRE, finalizing the iconic name.
And the Richard Ellis merger wasn't just administrative, was it?
No, it was a huge statement of global intent.
Yeah.
Richard Ellis was a major player in Europe and Asia. In the same year, they bought the big UK firm Hillier Parker. So in just 12 months, they went from being a mostly North American company to a true global competitor.
But then comes the strategic shocker. Just 3 years later, in 2001, CBRE was acquired in a leveraged buyout. They went private again.
For $800 million, led by an investment group called Bloom Capital. And this is the critical piece of the puzzle. Why go public, only to go private again 3 years later?
Especially when the valuation jumps from an $80 million IPO to an $800 million buyout in just 5 years. That's a 10x increase.
The LBO allowed them to do something crucial. It let them aggressively restructure and integrate that massive Richard Ellis merger away from the spotlight, away from the pressure of quarterly public earnings reports.
So they could do the messy work in private.
Exactly. Private equity loves to come in, cut costs, streamline everything, and then sell the much more efficient company back to the public markets at a higher price. They used that 3-year window to forge CBRE into a unified global machine.
And it worked. The private ownership was short-lived, which signals the restructuring was a success. And in 2004, they came back to the public markets with a second IPO.
This time raising a massive $454.9 million,
Far more than the first time around.
which just proved that the strategy worked. They had matured the company, integrated the acquisitions, and now they had the institutional backing and the capital to launch the next phase. Total acquisition dominance.
And now we're in the modern era, the period of these calculated multi-billion-dollar acquisitions, all fueled by that 2004 IPO and that private equity mindset. This is where they really secured their dominance by just buying up expertise.
Right. It starts in the mid-2000s. In 2006, you have two huge markers that confirm their top-tier status. First, their shares were added to the S&P 500 index, a big stamp of approval.
And second, and this was the real industry earthquake at the time, was the acquisition of their major rival, Trammell Crow Company, for a staggering $2.2 billion.
That $2.2 billion price tag was a declaration of war on the rest of the Big Four. Trammell Crow is an institutional powerhouse, especially in industrial real estate and development services.
So by absorbing them, CBRE wasn't just getting more market share.
They were acquiring best-in-class expertise in the exact sectors, logistics, and ground-up development that were about to explode because of e-commerce. They basically bought the future right before the 2008 crisis.
The timing was just crucial. They integrated this massive rival right before the downturn, which positioned them to weather that storm so much better than their competitors.
And there's a symbolic end to that story. In 2020, CBRE moved its own corporate headquarters into Trammell Crow's old building in Dallas.
A complete and total integration. They took the name, the people, the expertise, and finally, the building itself.
After that, their focus shifted to investment management. In 2011, they acquired the real estate investment arm of ING Group for $940 million.
And the ING deal is a perfect example of targeting those high-margin service lines. They weren't just buying more brokerage desks.
No, they were acquiring a massive portfolio of assets under management, or AUM, and the institutional client base that came with it, especially in Europe. That deal instantly shot them into the top tier of global real estate investment managers.
And it stabilized their revenue, right? Less reliance on volatile transaction fees and more of those steady recurring management fees.
Precisely. And then finally, in 2011, they formalized all this by changing the corporate name to simply CBRE Group, Inc., focusing on that core brand.
Okay, so next they move towards that vertical integration model we talked about. They start buying competence, not just competition.
Exactly. In 2013, they acquire Norland Managed Services, a specialist in facilities and energy management, particularly strong in the UK and Ireland. This deepened their operational capability, especially in sophisticated energy management, which was an early nod to sustainability.
And that pattern just scaled up massively in 2015 when they acquired Global Workplace Solutions from Johnson Controls.
That was a huge injection of expertise into their occupier services. Acquiring GWS cemented their role as the world's leading outsourcing provider for corporate workspaces.
So this wasn't just about managing light bulbs anymore.
No, this was about handling these enormous, complex, global contracts for Fortune 50 companies who wanted one vendor to manage every single one of their buildings, from Tokyo to London to São Paulo. This is what critical mass in a service line looks like.
They didn't ignore technology either. In 2018, they bought a company called Facility Source for $290 million. What was the motivation there?
In modern facilities management, data is everything. You need platforms that handle work orders, vendor management, predictive maintenance. Facility Source was a pure play for tech-enabled services. It ensured CBRE could offer clients not just people on the ground, but a superior software platform that saves the client money and generates high-margin fees for CBRE.
We also see a niche move in 2019, acquiring the London developer Telford Homes.
Which is interesting because they're a commercial giant. But this shows a strategic move into high-value residential development in a critical global city. It diversified their development arm into a very lucrative sector.
All of these acquisitions seem to be building towards something.
They are. They're building toward the ultimate strategic move.
And here's where it gets really interesting. Let's talk about the Turner & Townsend deal. This is their most recent, and you could argue their most transformational move yet.
This deal was announced in 2021. CBRE paid a massive $960 million for an initial 60% stake in the UK professional services firm Turner & Townsend, or T&T.
And TNT is not a traditional real estate brokerage. They're not like JLL or Colliers.
Not at all. They are globally recognized experts in cost management, program management, and project management for huge, complex infrastructure and development projects. Think airports, hospitals, massive public works projects.
So by buying them, CBRE is fundamentally changing who they compete with.
It's not just the Big Four anymore. By acquiring T&T, they're entering the world of high-end technical consultancies like Arup. They're even starting to challenge the implementation arms of firms like McKinsey in the infrastructure space. They're selling highly specialized, non-cyclical professional expertise now.
And the plan for this partnership became crystal clear in June 2024. CBRE announced they were merging their own project management businesses into Turner & Townsend.
And the structure of that is so telling. They aren't merging T&T into CBRE. They're merging CBRE's muscle into T&T.
Which signals that they see T&T's brand and expertise as superior in that niche.
Exactly. And CBRE is just using its own massive scale to supercharge the entity they acquired.
And the scale of this new combined business is immense. The sources say it's creating a $3 billion business with over 20,000 employees in 60 countries.
And on top of that, CBRE plans to increase its ownership stake to 70%. The implication is just crystal clear. This is a deliberate pivot away from relying only on traditional brokerage, facilitating transactions, and towards vertically integrating these high-margin, specialized services like construction management and technical consulting on a global scale.
They're becoming indispensable across the entire development lifecycle.
From the first idea, through the construction, and all the way into operating the building for decades.
They're buying the intellectual property needed to create the built environment of the future. It's a move right up the value chain. A huge move. What an incredible journey. I mean, we started with Tucker, Lynch, and Coldwell back in 1906, went through that bizarre Sears detour, the private equity pivot, multiple IPOs, and we've arrived at this $35.8 billion behemoth, CBRE Group, Inc.
And we saw how their dominance really rests on that clear division of services, the operational side for occupiers, keeping those 95 Fortune 100 companies running smoothly, and the sophisticated financial side for investors, focusing on capital markets and investment management.
And the fuel for all this growth, it was really those calculated strategic moves. The private equity cycle that let them restructure, the split from the residential business that allowed for intense focus, and critically, those aggressive targeted acquisitions.
They didn't just buy rivals. They bought expertise.
Ah.
Trammell Crow for domestic muscle, ING for investment assets, and now Turner & Townsend for that deep, specialized professional scale.
They understood that sheer size is meaningless without deep expertise in these high-margin businesses.
And their ability to integrate all of that into one global offering is their competitive moat. It's what keeps them on top.
So what does this all mean? Well, the key takeaway for you listening is that the world of commercial real estate is controlled by just a handful of these massive firms, and CBRE sits at the very top.
When you look at almost any major office tower, any huge logistics center, or corporate campus in any major city in the world, the odds are incredibly high that CBRE is involved somehow. It's management, it's leasing, it's financing, or it's sale.
They are the hidden backbone of global corporate infrastructure.
And that leads us to our final provocative thought for you to consider. CBRE is aggressively moving toward professional services, shifting from a transactional model to more of a consulting model.
Right. So given their 2024 plan to merge their project management arms into Turner & Townsend, creating this massive, specialized $3 billion global business.
What is that relentless focus on managing construction and development, literally building the future, suggest about where they see the market going? Are they betting that the highest value creation isn't in trading the buildings of the past, but in developing the new environment and managing the complex infrastructure projects of the future?
Food for thought indeed. Thank you for joining us on this deep dive into CBRE Group. We'll see you next time.